Hello, friends. Welcome. Hello? Mic check 1 2 1 2. Good to see everybody in the chat before I even got here today. Making sure everything's running and then we'll get this thing started here. All right. Let's go. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. It's your boy. How you doing? Hope everyone's having a great day. It's Thursday, February 29th, 2024 in beautiful Austin, Texas. It's 11 a.m. Thanks to everyone for being here. Smash the like button if you haven't already. Got a few things to talk about today. Will there be a redemption arc for TXMC, or will he continue to double down? Dylan asks in the chat before the stream started. Well, friends, there is no need for a redemption arc. I have not been disgraced. What has happened is that Bitcoin went higher than I thought it would go. That's actually a good thing. I was wrong about that. There's no hiding it. I was wrong. But there is no need for redemption. We do a lot of work on this channel so that our views are well reinforced by evidence and analysis. They're not feelings. So when we get something wrong, we simply learn from it and continue moving forward. Some of our ideas about the economy are still playing out, and they have not been invalidated by the big wheel of time. We still have a lot of runway left on that particular thesis. And it's important that we continue to separate those two. Now, I have been guilty at times of merging them together because for part of this cycle, the ideas about Bitcoin's market and the ideas about got the hiccups, but the ideas about what would happen to the economy and then affect stock market and then thus Bitcoin and whatever else, those things were all kind of lining up and playing out concurrently with each other, and in many ways still are. But along that way, I also had an idea that if those things were to play out, if we were to get a recession or an economic slowdown, which the data strongly supports, might I add, another reason why there's no need for a redemption arc here or a huge mea culpa. The data strongly suggests that that could have happened and may still occur, that there is still runway for that to happen. And so if that were to play out, then my idea that Bitcoin wouldn't reach back into the 60Ks before that would have played out maybe more accurately, potentially. We'll never know at this point. But BTC's been stronger than that. It has run harder in a shorter amount of time than I thought it would, while we still watch for other ideas about the market, about the economy, about maybe a recession, about a global slowdown. Those kinds of things are still playing out, still developing. I just assumed that they would have catalyzed in a more obvious way, if they were, before BTC got all the way back up here. So that part was wrong, and that's how it is. That's also why when we have an idea about something way in the future, we don't just bet the house on it. Like that people think that's what we do on this channel, that we get an idea about something way in the future and we position every ounce of our net worth for a faraway outcome, close our eyes and wait for it to happen. But no, this is actually great because Bitcoin is worth more. My spot bags are worth more. Hopefully yours are as well. We are invested in this market. We will continue to be. I would never bail on my Bitcoin position because I thought that there was going to be a recession. Like that's just because I think that's not going to drive me to act. So I never did. I never hesitated to leave my position at any point last year or during any of the downturn. I was buying Bitcoin in 2022, and here we are. It went a lot higher than I thought. I had a trading account that I had some BTC in, not my spot bags that I invest in and I just kind of put off to the side. I'll always have some off to the side. But I did have a trading account, and as BTC was breaking out here, I sold some pieces of the BTC in that account that I had picked up back here for the swing play. And I'm still holding some alts that I built exposure on in Q4. And I'll probably start to let those go sometime soon. I don't expect to hold those forever, but sometime here in the near term, in this cycle, in the next month or two, maybe, if timing works out, we'll see. I'll probably get rid of the vast majority of that stuff. But yeah, sitting here looking at BTC, this is a really kind of in a spot where maybe it kind of maybe the momentum starts to slow down a bit here as we get into the actual highs. I don't really know, and I'm not going to spend a lot of time trying to guess where the Bitcoin price goes, because for a couple of reasons. One, I was wrong in the first place, right? I thought maybe in this area here would mark the highs. Now, granted, this candle is still printing. If it comes all the way back down on some nasty doom crash, maybe our previous thesis gets a second life. But let's not get into that now. That's not what we're looking at. I'm just going to be an appreciative observer of the price here, because I don't feel discouraged in my general outlook for the economy in 2024 and 25. None of that has really changed. What I think is remarkable, though, is that Bitcoin has been so strong, and that people who are already in the crypto market are so bullish already. And it's just it's a heady mix for us to not even be at the all-time highs. And, before yesterday, we were still actually quite a bit further away from it. We were still down here below 54K. The sentiment is as if we were significantly higher already. And it kind of stretches the fabric of reality to think that we could stay as excited as people are now for a whole year, that we would maintain this level of exuberance. And I call it exuberance, and some people will disagree with that because they may point out things like, well, TX, Google search trends for crypto are way down, and we don't have, different L2s and exchanges and stuff fighting over naming rights for sports teams and stuff, and we don't have Reese Witherspoon tweeting about Ethereum at the top and all this kind of shit. Those things did happen in 2021. We also had JPEGs of rocks going for $2 million, and GameStop at $250 a share, and everything under the sun was at all-time highs. Everything in the whole world was at all-time highs. So that was a huge frothing mania. We talked about some of that last week. And so from my perspective, I think that's not the marker for what exuberance looks like. That's beyond that. That's a whole other level above. And for many investors, the 2020 and 21 cycle was their first real taste of a bull market. And so that's their baseline. And that is a crazy baseline. Just imagine that your first full cycle is the everything bubble. It's when they rain down $3 trillion on people through, forgiven PPP loans and stimmy checks and, employment assistance and all this kind of stuff, moratorium evictions, everything like that. That market becomes your only exposure to what a bull market looks like. And so you are assuming that is what it's going to look like at the top again. Whereas my perspective is a little different. I actually think that's extreme. I don't think that we'll be able to get back to that at the level it was. Certain assets might return to a price they saw at that point in time. But I'm talking about the entirety of the market, not just crypto, everything, right? That's what 2021 was. So will we get back there again? I don't know. I think we would need to see more money coming down from the heavens, more easing of financial conditions from a policy perspective rather than the market itself just frothing and easing conditions on its own. So I'm not sure where I stand on that, but I do think there is, and I say this with a grain of salt, knowing that the price has already been stronger than I anticipated. So at the end of the day, I don't know anything, right? These are just my opinions. That's why I always express to you guys, don't make your own decisions based on things I say. I'm just expressing my views to you. I want an outlet. I want a place to put my ideas, and this is it. So if you're following me here, it's because you find them entertaining. It's not because I am your financial advisor, right? So let's get that clear. But I don't know where the high is, but it does seem to me that when you consider all of the various headwinds for the market and for the economy for this year and next year, and for us to already be back at the highs, for the people who are currently in the market to be as bullish as they are, and for the outside criteria, the factors around the market to not be nearly as supportive as they were 3 years ago, makes me think that this can't go on for the whole year. Maybe it goes on for another couple of months. Maybe it goes on for a quarter or two. I really don't know. But when you think about all of that and the fact that a market is a physics-based entity, right? It has momentum. For the momentum to already be this strong this early, it's hard to fathom a world where it maintains throughout the year from this point. Now, some of the evidence for that is apparent in TradFi. Right now, I know Bitcoin ripped, and if it's going to slow down, some of the alts are going to rip. I'm betting on that, right? We're already seeing some of that. It's clearly meme season. Look, Bonk and Shib are ripping. Doge is up, right? So the crypto market is alive. And as I have said in different framings before, I think that the crypto market will continue to self-fulfill its own 4-year cycle prophecy until it is interrupted. I've said that on Twitter before, and I've said that on here before. No matter what I thought about the economy, no matter how we study recessions, the business cycles, or the timing of any of those things, until there is an apparent interruption, crypto will probably just fulfill its own destiny because the people in the market believe that is going to be the outcome, and their actions will drive it to making it happen. So we're seeing that now, right? The time is nigh. This is when crypto awakens, and here it goes. How high it goes, I don't know. My initial feeling was that BTC wouldn't get back towards its highs, but here it is. Interestingly, the timing of it getting back to its highs is pretty consistent with past cycles. If you average out the amount of time, excuse me, hit my mic. If you average out the amount of time between a Dow Jones breakout from a prior high and Bitcoin breaking out, it averages out to about 61 days. Well, the Dow Jones broke out into an all-time high 77 days ago. And here we are ripping to the highs, like really fast. So the timing is kind of working out in that way, from a cyclical perspective. This is when it should happen, right? This is when things should start picking up. For us to have already been up here relative to the halving, that's a little different. Usually this happens after the halving, and we haven't even gotten there yet. So from that perspective, it's a bit different. But some of the other timing elements aren't that weird. But like I said, we can look in TradFi to find some other elements that kind of just make you scratch your head. They make you scratch your head. They're not a proof of anything needing to happen in a particular way, but if we're analyzing things in a holistic way, which we have to, you can't just look at one data point. We can't just look at Bitcoin and crypto. We have to consider everything. There are interesting things to talk about in TradFi. So let me point out one of those. The first one I'll bring up, and I hesitate to bring this up because it's not proof of anything. And if you run a back test, this doesn't always align with price having to do a certain thing, but we'll just put it on the plate with the other things that we're about to mention. Inside the market itself, the participation near the highs has been thinning. And what I think is interesting is that on the NASDAQ, if you look at the number of NASDAQ stocks above their 50-day moving average, which is the yellow line right here, Here, let me show you where the previous high was on the NASDAQ first. Here was the previous all-time high. Right here, this will make it bright pink. This line right here was the previous all-time high. When NASDAQ got back to it and finally broke over it, breadth started declining. Like at that exact moment. You see that? And so since we have pushed higher on the NASDAQ into all-time highs, the number of stocks participating in that move has been getting less and less. And since February 13th, which was 2 weeks ago, we've been bouncing around and setting 4 times. We matched the low on this value, on the number of stocks trading over their 50-day, while the NASDAQ's just been hanging out here at its highs. And you guys know, some of you may have discounted these things now because they didn't play out exactly as you thought. However, relative to the fib levels that we've been watching all this time, which are still very relevant from a cyclical perspective, we're hanging out right at those levels as we're seeing the breadth that I mentioned deteriorate from pushing above the all-time high. I just think it's kind of an interesting dynamic, something I'm paying attention to, but this on its own won't drive any kind of big opinion about mine. But when I see that, there's also other places, like if we look at the whole market since the lows in October of 2022, that was the lows for TradFi. Since that moment, what has been driving stocks higher is the mega caps. There are stocks across the index that are going higher. It's not just the magnificent 5 or 6 at the top of the market cap list, but they are the leaders. They're driving most of the gains. And if you look since the lows, this is a percentage change since October of 2022. The NASDAQ is all the way up here at the highs. The mega caps, this is a mega cap ETF, so it's just the biggest companies in America, is up here 45% off the lows. S&P is up 40%. And then we have this big gap. And down here is the rest of the market. So the Russell is up 20%. That's the bottom 7% of companies. This is the equal weighted S&P. It's only up 25%. And then we have credit ETFs. High yield and investment grade are both way down here, below even the performance of microcaps. Now, if 2022 was the end of whatever drawdown period this cycle was going to endure, and if we're now on the upswing on a sustainable basis, I know we just spent a year going up, but I'm talking about a multi-year expansion, which is really the debate I think that people are having in their minds. Is this the beginning of a sustainable bull market, or are we just going to chop around for the next couple of years like we have for the last 2 years? Well, if we consider that the lows were in 2022, of October 2022, if we're going to think that this move now on the markets, this push higher, is the beginning of a multi-year expansion, that there's no recession, that there's no downturn, and that the bear of 2022 is all we're going to get, this is weird. For these to be way down here, while there is such a massive gap, and then we have the NASDAQ and the S&P at 40 and 60% up off those lows, while everything else is 7, 8, 15%, that is a historical anomaly. That doesn't happen normally. If you go back and you look at every bear market since HYG and LQD launched, those are the 2 credit ETFs, they have led off the lows with risk assets. Same thing with small caps, with the Russell. If you go back and you look at every single bear market since the Russell's inception, with the exception of just 1 or 2 of them, they outgain the S&P off the lows in every single instance. Every one of them. I manually went and I counted every single bearish drawdown on the Russell and on the S&P for the last 35 years, however many years it's been. And I counted the percentage gains, and 90% of them, I don't have the table here, or I'd show it to you. 90% of them, the Russell outgains the S&P. Well, currently it has half the gains of the S&P. The credit ETFs, like I said, similarly, they also move up when we are in an expansion, when we're in a recovery, where business conditions are expected to be improving across sectors into the future. but we're not seeing that now. We're seeing the mega caps pushing higher. So I decided to do a little bit of analysis on the stock market itself. I did this last night. And I got a list of the top 100 companies in the US by market cap. And this is the list of them. And I went down and I opened every single one of these. And I made a note if it's been at least a year since their all-time high. And I found some interesting things. And those interesting things are in this table right here. So of the top 100 biggest companies in America, 57% of them have not seen a new high in over a year. Over a year since the last time they broke their prior highs. Of the top 5 companies, 4 of them have made a new high. One of them still hasn't. That's Amazon. Of the top 10, 30% of them have not made a new high in over a year. Of the top 50, almost half, 42%. When you look at the bottom 50 of the top 100, so companies 51 through 100, 72% of them have not seen a new high in 365 days or more. Most of them have a high from late 2021, early 2022. Most of them. That is also an historical anomaly, considering that at the index level, the stock market bottomed how many months ago? 17 months ago? 16 months ago? October 2022. And the index is now above the high that preceded that low. But 57%, 57 of the top 100 companies haven't had a new high in over 365 days. Some of them look really bad. And these are big companies. These are not joke companies. Qualcomm, IBM, Verizon, Pfizer, Amgen, Nike, Morgan Stanley. Like, these are not Lowe's. These are not small companies. So there are weird divergences going on. As far as the Russell goes, I think a lot of it has to do with the refinancing wall that we've talked about here quite a bit, how corporate America has not accessed current interest rates. And we're still waiting to see that happen. And if you look at if you follow these topics on Bloomberg or on the Financial Times like I do, there is growing concern about the ability of companies to refinance if the Fed isn't going to cut rates anytime soon. Well, they may not be able to cut rates anytime soon. If you look at GDP now, Atlanta Fed GDP now is currently at 3% for Q1. 3%. Just shopping around. That's above potential. That's 50% above potential. Potential is considered to be about 2, maybe 2.5%. So we're above potential growth on a real basis, on an inflation adjusted basis, largely because income growth is really strong. Today, the CPI report came in, and Supercore, which is core services minus shelter and housing, that rose 59% or 0.59%, sorry, month over month. That's one of the biggest raises that it's had in the last 2 years. Let me find a chart of that. Hold on one sec. Core services X housing. I know someone on here is going to have a chart. Because I don't have this chart readily available. Core services X housing, 3-month annualized. This isn't the month over month, but this is core services X housing. And you can see the acceleration here in the last few months. This is services minus the housing component that has that lagging shelter piece that people always use as a way to kind of hand wave away lagging sticky CPI. Well, this figure is picking up. And there are latent inflationary pressures across the basket. We've spent so much time on this in the last couple of years. I don't even know which chart to pull up right now to make my point. It's starting in July and August of last summer. We started talking about the idea that we were approaching peak disinflation, right? That was something I mentioned on here, and I had a whole Twitter thread about peak disinflation. Let me see if I can find it. Peak disinflation. Yeah, when we look back in a few months, it's likely this week will have marked narrative inflections for peak disinflation and peak soft landing. So I got some of this wrong. The peak soft landing narratives carried forward into 2024, but peak disinflation is what I said. This was July 14th of 2023, last year, right? Well, let's go look at CPI. July, right here. So since I made the tweet about peak disinflation, CPI has not fallen, right? It's just been going sideways. It fell. And I said, guys, we're nearing the point where CPI is not going to keep falling. I tweeted that here, and it's been going sideways for half a year. And it's because the rate of change was turning. We saw this in our charts that showed 1 month, 3 month, 6 month annualized CPI all starting to curl higher a little bit. And those have dragged the year over year figure sideways. And here we are hovering at 3%, which is 50% above the Fed's inflation target. Then we have real GDP growth above potential. Who thinks they're actually going to cut rates? Now, how much time have we spent on here talking about how the Fed, they said that they assumed they would cut about 75 basis points this year, which equates out to roughly 3 cuts. And for the last 4 months, I don't even know how long it's been, we've watched as the market has simply not believed the Fed. They have priced in 6 or 7 cuts, then they lowered it to 5 or 6 cuts, and now they're finally coming around. And they're finally starting to accept that maybe there won't be the massive amount of cuts that we priced in. So then you have to carry that forward. Okay, well, what does that mean for the markets? What if they're wrong about those things? Well, what did we see at the end of last year? We saw the sharpest easing of financial conditions we've ever seen, and it was entirely market driven. It was entirely driven by yields collapsing in the fourth quarter while risk assets mooned, right? Yields collapsed, risk assets took off. This was the actual Pico bottom of the NASDAQ on its little pullback right here. Right there, you can see that the 10-year rolls over, the NASDAQ takes off, massive easing of financial conditions. This is the market going, holy shit, we're done with the Fed tightening cycle. Cuts are coming, and we think it's going to be a bunch of them. So bid duration, bid risk, let's go. And now we have strong GDP. We have had surprise CPI. It's stickier than expected. Today, core services, ex housing, jumped at the highest rate that it had jumped in quite a while. 0.59%, whatever number I said. But yeah, 0.59% month over month. And we have the policy trap brewing. This year is setting up as a potentially historic policy trap for the Fed, caught between the reawakening of their nemesis and inflation and the total arrest of credit markets due to the secular end of zero interest rate policy after far, far too long. So we're still going through this. We have cash-rich, mega-cap companies driving the vast majority of gains in the stock market as the stock market pushes up to new highs while fewer and fewer stocks participate. And we have this really strange historical divergence between everything in the stock market except the mega caps. These are the mega caps. NASDAQ and the S&P are cap weighted by these mega caps, these mega cap tech companies. It's pushing these up while everything else is benefiting but not really taking off. It was only recently that the equal weighted S&P poked above its previous all-time high. Just recently. Here. Is this it? No, my gosh, it's not even doing it here. Why did someone tell me that it had? Oh, I see, on a closing basis. It's there on a closing basis. So that's part of the reason why I think the market's story and the economy's story are a little different. But we can also check in on economic growth, which I think we should do here. check in on it and just see where we are relative to the big wheel of time. Because, I know that with what Bitcoin is doing here, with all the excitement around it, there are probably a lot of people now asking themselves, does that mean the recession is canceled? Does that mean the new bull market is back on? Look what Bitcoin is doing. It's the fire alarm. It must know something. This must mean XYZ. I'm not there. I don't know I don't know if this has any meaning because of the behavior I see elsewhere in the bigger markets, the markets that are worth much more money and have much more volume going through them. There's behavior here that is unsettling. And when I saw this table here that over half of the top 100 companies haven't had a high in over a year, it's really concerning to me. 42% of the top 50. So from a market perspective, as we sit up here at the highs near these retracement levels that I've already drawn on here they are, near the retracement levels, and we're just kind of hanging out. I said a couple of weeks ago as we got to this point that this isn't going to be some hard line in the sand where price could not go above this level. I've said that the way I think it should be looked at is as kind of a cyclical mark in the road, where it might be hard for price to gain much more beyond this, considering all these other factors we're talking about and the fact that it's already up so much. Can it go higher? Yes, I hope it does. I hope I'm wrong about everything, but I have to consider these factors in the lens of history. And through that lens, it looks a little sus. The participation is not quite there. On an economic side, kind of putting the stock market and Bitcoin and all that stuff aside for a minute here. If we just think about growth of the economy and we pick those pieces out, credit has completely halted. And I'll show you guys in here in just a minute. There was an updated household debt and credit report that shows new delinquency numbers, and they continued accelerating. I think we might have looked at it briefly a couple weeks ago, but I wanted to bring it back today because I saw something else related to it. But credit growth itself has completely halted. And in this cycle, the black line relative to prior cycles, the gray line, a much faster slowdown in rate of change terms for credit growth, for total loans, consumer credit, business loans, real estate loans, total bank credit. This is the whole slice of the credit market here. Doesn't look particularly great. With cyclical things. These were the parts of the economy that we saw first last year, that we noted weakness in first in terms of their growth rates since the Fed began raising interest rates. Industrial production, real manufacturing sales, real retail sales. These are three things that tend to draw down first, and their growth rates slow first as they are more interest rate sensitive and more pro-cyclical. So those growth rates did slow really heavily. You can see they broke below zero, the black line did, and that was also pretty quick compared to history. But where we are now, these series are chopping around. At times they show moments of acceleration, and then they'll give it all back, like we've seen here on real retail sales, where we just get this kind of choppy buildup. It looks like a coiling spring almost, but this is an economic series, not a price chart. But we can see out ahead of us, there's plenty of uncertainty in past cycles where the Fed raised interest rates. So are we out of the woods yet? No. Is a reacceleration in manufacturing sales a good thing? Yes, absolutely. But we're not seeing that follow through in industrial production or in real retail. On the housing side, housing is a weird one because we have prices largely elevated from where they were before, but we have prices elevated where they were before, but we also have a ton of units under construction that haven't quite come to market. If you look at total units under construction, it's at all-time highs. But which partly explains the slowdown in total units under construction at the beginning of this tightening cycle. But now we're seeing single family housing construction start to pick back up a little bit, which will just add on to the already all-time highs that we have in multifamily construction. So units under construction. New privately owned housing units under construction. Yeah, see, this is at all-time highs. And we've been hanging around at all-time highs in units under construction since the middle of 2022. Like, it's almost like the whole housing market is kind of frozen up in a growth rate sense. The progress is not falling, but it's not rising. It's hung in a stasis here. You see that? It's just very odd. I'm not a housing expert, so I'm not going to try to jump to conclusions about what this means. But it's something I wanted to touch on just because it's part of the cyclical framework we look at, looking at housing construction, looking at housing permits, things like that. Permit growth is way below the normal average. It's slowed down, even though we've seen it picking back up here in the last year or so. Its growth rate, its change from the peak, is below the normal drawdown of housing permits from their highs in past cycles. Hold on, I got to open another tab. I accidentally closed my chat, guys. I don't know what I did. I'm just an idiot. Let me put it back up. I got to bring my chat back up. Yeah. All right. So carrying on, a couple more things I want to touch on, and then I'm going to stop and I'll check on you guys in the chat. The piece of the economy that's really driving things right now is demand. It's incomes. It's people spending money. Now, when I mentioned core services ex housing inflation jumping in the last month and making the Fed's job harder, core services ex housing is in large part wages. Services is very labor intensive, and the inflation in services tends to correlate heavily with the inflation in wage growth. And in this cycle, real incomes are quite strong. In past cycles, real incomes slow down as the Fed is raising interest rates. But in this cycle, we had the initial fall in real incomes in 2022, but they've been accelerating since. And in large part, this is because of high interest rates allowing cash to earn a yield for the first time in 20 years while we have full employment, right? Most people who want a job have one. Wage growth is hanging out really steadily in the 4 to 5% annualized range, and real personal income on an inflation adjusted basis, in part because of cash deposit rates being so high and money market funds gaining so much. We're seeing real personal income rise on a growth rate basis. And that is helping to keep real consumption over here slightly elevated from where it normally is at this point in the cycle. This real income, real consumption, this is where all the strength in the US economy is currently filtering from. As long as everyone remains employed in this period while we have kind of elevated rates, it's likely that this could continue on for a period of time. We've seen savings coming down, so there may be certain places in the economy that start feeling a squeeze, maybe some places that have more recreational spending, but just baseline PCE remains elevated because things cost more, people are willing to pay more for them. Even though we're complaining about inflation, even though sentiment is quite low compared to history, the numbers bear out the truth that demand remains pretty robust. However, labor is slowing down dramatically. It isn't on a zeroed basis. It's not on a shrinking basis. But when you look at past cycles and we look at non-farm pay, we talk a lot about non-farm payrolls on here. This is the non-farm payrolls line. It's all squished together, but this is non-farm payrolls. This is household employment. Non-farm payrolls is following the pre-recessionary path really closely. Household employment is much weaker. The blend of the two together, the blend of these two together, also produces a weak looking series relative to past history. If we blend average hourly earnings with Average hours worked. We get a composite worker, which is like a fake weekly income worker. And that figure on a historical basis is collapsing relative to the normal history, relative to the pre-recessionary series. That stuff is concerning to me, right? Let me show you this one here on a bigger chart. Where is it at? Wages. Here. This is average weekly hours times average weekly earnings, right? So you get a composite worker. It is pretty choppy, but this is back in the 70s, right? When we had high inflation, high wage growth, booming demographics, a little bit different of a situation. Over here, we've had really strong weekly wage composite growth, but now it's collapsing back down to 3%. What was the average of this series? Let's see what the average of this series was after COVID. I'm sorry, after the GFC. So this averaged 2.5%. So we're still above the average growth rate from the GFC to COVID at 3.2%. The average is 2.5%. But with the rate of change, with the trend currently, I imagine we'll be back down to that level here pretty soon. We'll be back down to relatively normal rates of composite wage growth at a place where everything costs, 40 to 60% more than it did 2 years ago. I'm a little dubious on that one. Was there something else in labor I wanted to touch on? These were some of the other pieces that we don't look at all the time in the labor market. So we focus a lot on non-farm payrolls, on the household employment figure, on the blend of those two things. Those are the headline numbers that most people follow, and they give you the most kind of zoomed out look of employment. But we can zoom in a little more. And some of those figures also look recessionary. They're following those things. Temporary workers slow down considerably, as it normally does. The number of people who call themselves unemployed has been rising, commensurate with past recessions. Long-term unemployment has actually fallen a little bit back down to break even on a growth rate basis, on a 6-month change basis. But this is usually something that we see accelerating early in the cycle. We've seen a little bit of that. Part-time for economic reasons, very noisy series, but starting to lift off as we would expect while vacancies fall. So all of this aligns with a business cycle reaching its conclusion rather than the beginning of a new one. When you combine that information with the view that we took over here about the divergence inside the equity markets, where mega caps are pushing the indexes higher, above their highs from 2021 and 22, but much of the market is not participating. Pieces of the market that historically do, like the Russell, which historically outperforms the S&P off the lows in a gains perspective, in a percentage change terms perspective. That stuff also, when you think about the top 100 companies, half of them not even making a high in over a year. Still being below their 2022 highs, 2021 highs in a lot of instances in this list here. It spells out to me that I should clearly remain hesitant here. I will stay long my Bitcoin. I'm going to continue my crypto plan. I have my long spot Bitcoin bags. I'm long a bunch of alts. I'm going to wait to see the manifestation of whatever alt season we get. And I will take profit on as many of those things as humanly possible and then roll it back into smarter assets. I'm not going to become an altcoin bag holder. But the timeline for the economy remains quite uncertain. And we're still in a place where if we look at job growth, sorry, not that one, this one. If we look at job growth, we still have a lot of recessions that have occurred out in front of us. We're still following it on a rate of change basis. And now it looks like the Fed won't be able to cut rates like everyone thinks, which will just raise the risks further. Now, I know it took me 45 minutes to get to this point now where I've explained all my views, but sometimes it's what it takes, There's a lot of things to talk about. There's a lot to look at. If you want a channel where you're going to sign on and the guy's going to go, BTC's up 20%. Buy corn. Hodl. We're going to the moon. Well, then that's not this channel, right? I have my own way of doing things. And I see a very worrying picture. And a lot of my friends who are Bitcoiners are demonstrating the kind of behavior that you see at the end of a cycle very early in what they perceive to be what should be a great 2024 and maybe even into 2025. I think that they are showing sentiments of being up here and they think that they're right here. And I just, I'm not sure about that. I'm just really not sure. Not when I think about all this other stuff. So I'm gonna take a sip of my water here. The thing about the credit markets that I'll touch on, I'll make one last point here, and then I'm going to hang out with you guys in the chat, and then we'll just see where the rest of the stream takes us. So we've seen rising delinquencies in the credit markets, and that's something that is late cycle. We're seeing the acceleration of delinquencies transition into delinquency, the acceleration of auto loans and credit card loans commensurate with what recessions look like on a rate of change basis, though they're coming from low areas. Serious delinquency, also seeing that kind of acceleration. That is concerning. And I'm seeing some analysis now. So there's this other survey that's called the Senior Loan Officers Opinion Survey, SLOOS, SLOOS. The SLOOS survey is one that asks banks, what are you seeing? How is the demand for loans in your business? Are you creating more loans? Are your customers asking for more loans? What's the nature of your lending? Are there reasons why you are or are not lending more or less? It breaks into all of those things. And it's a quarterly survey. And just recently, this quarterly survey started to fall. So where is it? See this red line? This red line is the survey number that gets spit out. Banks tightening for commercial and industrial loans, business loans. And so when this value is rising, more banks are responding to the survey and saying we are tightening our standards for loan creation, right? And that's something that happens late in a cycle. They tighten their standards, meaning they become more discriminating in who they loan to. And that usually happens after the Fed has raised interest rates. So here's the Fed funds in black. This is the great financial crisis in the middle. The Fed raised and then held. And then as we approached the recession, banks started tightening in mass. The orange one is consumer credit card loans. So you can see it's very similar, but we're just going to look at the business loans. Same thing happened back in 2000, right? The Fed raised rates, then banks started tightening, then we had a recession. Over here, in this cycle, it's been a little different. So we've had the Fed raising interest rates here, and at the exact same time, the banks were tightening their lending standards. There wasn't the delay. In the past cycles, we had the Fed raising rates, then the banks tightening, then the recession. The Fed raising, the banks tightening, then the recession. Over here, it's happening at the same time. That's new. So that's just a different dynamic. However, now we see this value falling, right? The number of banks tightening loan standards is falling. So when people see that, I have seen analysis from people who work on Wall Street. These are people who make six figures. Many of them have like bachelors in economics, and they're saying banks are loosening their standards. Look at the way this line is falling. Less banks are tightening, banks are loosening. They're starting to lend again, guys. No, that's not what that means. All of these banks who did all of this tightening of standards, they are still just as tight as they were before. They are not beginning to lend. They're becoming just as much scrutinizing as they were before. Some of this is manifested in stories, right? I was just reading it. Here's it. Car loans haven't been this hard to get since August 2020. This story is from today, right? So that is reflected in this. Here's auto loans. It's the same thing, right? So let's look at this survey. Let's look at this data. Why is this number falling? But I am saying that the banks are not getting ready to start creating credit again. They're actually just as tight as they ever were. Because if you look inside the survey results, it actually tells you. And this value here tightened somewhat, tightened considerably. These two answers to the survey are what produce this line going up. And so as this line goes up, it's more and more banks saying that our standards for loan creation, for business loans, have tightened somewhat. There's also, have you eased? Well, why are they all zeros? If these smart Wall Street guys are telling me that the banks are lending now, they're starting to lend because tightening standards is falling. No, it's actually zero. Zero banks have eased. The reason it's falling is because none of them are changing. Of the 62 banks that get asked this question, 53 of them haven't changed at all. Since Q3 of last year, 5 months ago. So this value is coming down because less banks are tightening because they already tightened. Only a few of them are tightening even further. 85% of them are still where they were. This is how data gets misinterpreted. You'd think it wouldn't happen so much, that people whose lives revolve around economic data, that they would misinterpret things so frequently. But they do. And I saw several people that I follow on FinTwit, respected people who I respect tremendously because they knew more about things than I will ever know, certain pockets of the market that I will ever know. But they get these kinds of things wrong because they don't actually understand what they're looking at, and it leads them to a conclusion that isn't true. And so we've got people saying, well, the banks are starting to loosen up. This is the new credit impulse. Get ready, guys. No, that's not at all what it says. And if the banks are where they are now, they may remain here for a considerably longer period of time. So I have a bunch of tabs open up here. I decided to go back and look at this survey, this exact table right here, from 2008 through 2011. And what I found was that once banks tightened their lending standards, it wasn't until almost a year and a half, 2 years after the recession that they really started easing up and creating loans again. Now, I know that we have to keep in mind that the GFC was particularly hard for commercial banks. So we can't just use their perfect fractal timeline and apply it to this cycle, but it's informative nonetheless. So if we look at Q1 of 2009, this is after Lehman collapsed. This was after the stock market had that horrible 2008. 2009 was the last part of the Great Recession. Let me show it to you on the chart. Excuse me with the hiccups. Let me show it to you on the chart. Here's the Great Recession right here. Let's add recessions. If you want to see this, go on TradingView, go to indicators, type TXMC, and you'll find I have a handful of them on here. And one of them is recessions. And you can just slap it on there and it'll show you the official dates of the recessions. And January 2009 was right here. So the market bottomed in March. Lehman Brothers was right here. Bear Stearns was back here. The movie of The Big Short took place right here. And so after that, banks didn't want to lend for a while, right? The banks went through a hard time. And so in January 2009, a bunch of them were tightening. Some of them were unchanged. 0 of them were easing. By Q2, same thing, zeros on easing. Still tightening standards. This is a year into the recession, guys. The recession started back here. And a year later, banks are still vice squeezing their lending standards. Q3 of 2009, 2 banks among the 54 say that they're kind of easing. Most of them haven't, and a bunch are still tightening. Q4 of 2009, back to zeros. Everyone's unchanged. A whole more than a year later. We get into 2010. This is when you start to see things loosening up just a little bit, just a tiny bit. Q2 of 2010, Q3 of 2010. The recession began in December of 2007. So if we go through a period that is tough for financial institutions because of the refinancing walls that are heading this way, because the Fed is unlikely to cut rates as the market expects, then we may have an extended period where credit is difficult to access. And that is a problem if you are an economy driven by consumption. And right now, the main fuel for all of that consumption is everyone is still fully employed with record high wage growth. Those things have to stay in place or we start running into some problems. And as I just saw today, car loans haven't been this hard to get since August 2020. This is an auto credit index, a credit quality index of auto loans. It's at August 2020 levels. This level here. It's completely collapsed in the last 3 years. 2 years. So the credit markets are in a really tricky spot. I'm starting to see more rumblings about people finally seeing what I've been talking about on here for months, about the risks in the private credit markets and the commercial real estate markets. Commercial real estate was already on some people's radars, but private credit was not. I've been talking about that with you guys for 4 or 5 months, and I'm finally seeing stories. Big investors grow nervous about private credit boom. Flawed valuations threatening private credit. And I talked about this with you guys before about how banks were playing accounting games and how they didn't want to mark to market their properties because they would take realized losses on them. And that's what's holding up the commercial real estate market, right? How no one wants to trigger price discovery in an illiquid market. There is a similar dynamic going on in private credit, and it's part of what makes it so appealing. The meteoric rise of private credit has been powered by a simple pitch to investors. Invest in our loans and avoid the price gyrations of rivals. Central bankers' rapid rate hikes over the past 2 years have strained finances, making it hard for them to keep up with interest payments. Suddenly, private credit shows up, letting funds decide themselves what their loans are worth, rather than exposing themselves to public markets. Data compiled by Bloomberg shows how some private fund managers have barely budged on where they mark certain loans, even as rivals who own the same debt have slashed its value. In one loan to Magenta Buyer, the issuing vehicle of a cybersecurity company, the highest mark from a private lender was 79 cents on the dollar. The lowest was 46 cents. So in private credit, that market is illiquid. They're kind of marking things wherever the fuck they want. And a lot of borrowers are going there because they can't access credit elsewhere. This is the same market where we are seeing payment-in-kind loans that allow people to take on debt to defer future interest payments or to defer current interest payments into the future. All of these behaviors are evidence of a market that is trying to avoid paying the current interest rate. And it's creating this illusion in people's minds that everything is okay, that we can actually survive at 5.5% rates, that businesses will be just fine, that we won't have a lot of high unemployment, that we won't have a crash in residential or commercial property values. And maybe we don't, but we can't prove any of that stuff because no one is refinanced yet. It's literally this chart, guys. We are seeing it happen. This story right here is literally this. So, This shit is not over with. So is there a redemption arc for TXMC after being wrong about Bitcoin? No. I was just wrong about Bitcoin. But I'll put my business cycle analysis up against any top dollar research service on the street, anyone on the globe that you can find that looks at the business cycles. I'll put my research up with theirs any fucking day of the week, and I'll take it to the bank. And I think that this cycle still has surprises in store for us. Water's good. Andy Philpott gifting 5 memberships early on in the stream. Thank you so much, Andy. Andy's an OG. Brandon Hammond also gifting a membership. Code 9 gifting a membership. Eric Martinson gifting a membership. Thank you, Andy. Thank you, Brandon. Thank you, Code 9. Thanks, Eric. You guys are awesome. Every week when you guys are coming out here gifting memberships to people in the chat. If your name is green, if you were gifted a membership, you will have access to our private member stream that we'll do next week after the public stream. We've done them once a month, and next week is time for another one. So we'll do our regular live stream, and then we'll take a little break, 30, 45 minutes, and then we'll get together for all the green people, and we'll hang out. We'll shoot the breeze, talk a little behind the curtain, a little more casual, less of a monologue. All right, I'm gonna scroll back in chat, see if I missed any big questions. If you guys want me to notice something you're saying, say alpha beta soup in the chat. It highlights the name for me and I can see it. If you say TXMC, I can see that, but I have to manually notice it with my eyes. But if you say alpha beta soup, it will highlight it red and I'll notice it. So if you really want to get my attention, you can do that. Super chats work too, but you don't have to do that. Keep hearing how March is a doom month, so it's probably bullish. Yeah, I don't really pay attention to people who say March has to be XYZ, February is going to be like this. There is a seasonality component, but it's not gospel. BCO says, just say you were wrong for the past year. Yeah, I can't entertain these kinds of things because I wasn't. I was wrong about how high I thought the price would go. But I said many times, countless times, that the door was open for higher prices. I just didn't think Bitcoin would get to an all-time high before we had a recession. That's what I was wrong about. Hear me out. I remember one of your videos saying, why is the only option to a full-blown market? It's like 21. Sorry, I don't understand that. I think money's going to Bitcoin through the ETFs is coming out of other equities, including the gold market. That could be true, Dave. We've seen some outflows in the gold ETFs here in North America, but they've been going on for a lot longer than the Bitcoin ETFs have been out. So I don't actually know if that's true, but, certainly possible. Sean says, I had a thought. The idea that liquidity has been drying up might be wrong. The infrastructure bill, the Inflation Reduction Act is liquidity that's filtering into the market. Yeah, Sean, I mean, we're running historic deficits. We're running 7-8% of GDP deficits. That is contributing to GDP. Did you know that government spending is an input to GDP? So if the deficit gets bigger, it naturally accrues to the private sector. It creates income, right? So that is propping up GDP. Also, 5 to 5.5% cash rates is allowing people to make money just having stuff sitting in the bank. That hasn't been true in a very long time. I think there's quite a few components that are propping up, quote unquote liquidity. I don't really believe in the net liquidity gospel, but generally speaking, there's a lot of cash in the market floating around. how accurate do I think the charts about extra savings being drained are? Alessandro asks. Yeah, so there's these charts about the net savings of the consumer, and they're based on kind of like a rolling cumulative delta between income and personal savings. I don't think that there's a lot to it. I think it's hard for me to take that chart and apply it to like the real economy. I don't think it's that black and white. When I'd rather look at like the Bank of America splits on customer account levels and things. Like Bank of America does each bank. Let me see if I can find it here. Bank of America Consumer Report. I think it's called Consumer Checkpoint. There it is. Okay, just go. Who cares? Here we go. Consumer Checkpoint. So Bank of America does these consumer checkpoints, and I think these are kind of interesting because they actually break out the data from their customers. And I haven't looked at this, so I'm just going to kind of speed through it. And see, they'll show incomes by different income brackets and things like that. They have interesting data to me. Credit card utilization by incomes. So I would say maybe check that out. I'll put the link to this in the chat if you guys want to kind of like poke through that. I'm not going to go through it on stream here because I haven't looked through it and I don't want to waste you guys' time if it's not that interesting. But every month they put one of these out and I like to go check them. And usually somewhere in here, households continue to have raised deposit balances compared to 2019. Usually in here, they show something like this that shows the change in deposits from right before the pandemic. And this is one of them. They've had a few different charts, but here's one right here. It shows deposits are still relatively elevated. But again, I don't know what that means because cost of living is also much higher. So the fact that people have 50% more in their bank accounts, but everything costs 40, 50% more, is that really good? I don't actually know. So that's why it's hard for me to take a chart of, the depletion of consumer excess savings seriously because there's too many factors. Chat's just popping here today, guys. CB renewing his membership. Says thanks, Andy Philpott. Appreciate that, man. I don't know if you were given that. You said thank you, Andy Philpott. I don't know if you were gifted that by Andy or what. Who's gifting all these memberships? Well, it's Andy Philpott. It's Brandon Hammond. It's Code 9. It's Eric Martinson. Sometimes it's Oscar Hernandez. We've had a few other people gifting memberships. Sick Thinkers gifted a few. I think CB gave a couple out. So you never know. Jacob says, curious timing on the United Health antitrust investigation, no? Jacob, dude, that's so funny that you say that because I literally texted this to BCB the other day. I texted him that story and I was like, that's kind of interesting, isn't it? Like that we have talked about United Healthcare being, it's the biggest piece of the Dow Jones. By the way, this is the largest component of the Dow Jones. It hasn't made a new high in 2 years, and they now have an antitrust investigation. In a year where healthcare defaults are rising, healthcare loan defaults are rising. So I'm not saying those things are all related, but it's just a little some. Did I learn anything from the Bitcoin pumping further than anticipated? No, I wouldn't say I've learned something. I think that here's what I think. So I was watching as we approached these retracement levels. I was watching for a signal that the market would turn around in here. Because if an asset is not going to new highs, this is usually where it turns around. 60 to 80% of the previous leg's move. That's just the way markets are, right? That's just kind of the fractal nature of price. And so all throughout last year and even, part of 2022, as we waited for a bottom to be established, my thought all along was, if Bitcoin ever gets back up into its retracements, that's going to be the really interesting time. However long it takes to get there, whatever it looks like, when it gets back to this area, that's when things get interesting. And so as we were in this area, that's why I ramped up my tweeting about being cautious, about this is where we should pay most attention. This is where rallies run out of steam. We saw on the ETF launch day, we looked across the market and we noted reversal signatures here on the 618 sweep, right, in early January. And we saw the same kind of signature on GBTC, on the BITO futures ETF, on BITI, the short ETF, on like everything, right? CME. We went across the market and we looked at everything. And I even said on that stream, this doesn't have to be a reversal, but this is what they look like. Well, price just turned around and wiped that away within a couple of weeks, right? Within about a month. And I think if I'm thinking back to myself sitting and watching this happen, there were a couple things I observed. One, I observed that sentiment in this area is precisely what I thought it would be in this area. It is absolute frenzy. Like everyone who's already in the market is losing their goddamn marbles over the fact that Bitcoin's going so high. The haters are losing their mind. All the hodlers are going crazy, right? It's elation. And that is what you would see in a retracement. However, price just blasted right through it. And we didn't really get the slowdown in momentum that you would expect to see. We didn't really get a breakdown in structure up in these highs. We started to have one right here when we swept these lows. That was it, but it just turned right around. Within 5 days, it turned right around. And so if I'm in another scenario where I'm watching for retracements before a high is reached, I think it can't just be the line in the sand. I think it needs to be similarly to the way that we look at the 4.236. And this is just my opinion, right? Everyone else is going to have their own views. But the way I'm thinking of it right now, I think it makes more sense to approach this the same way that you approached the 4.236 on a secular basis, where it's like, hey, this is probably an area where the market starts running out of steam, and continued gains beyond this point are considerably less likely. And up here, when the market is up here, this is when you watch for important catalysts that could turn things on a secular basis, right? If you start to see the market rolling over on technically just because it's up high, and then you get a couple of badly timed news stories when you've already got all this other data that's not very supportive, that's the kind of thing that can turn a cycle. And so when I see this kind of scenario, if I'm thinking in my head, maybe Bitcoin's going to run out of steam here, I need to see more evidence of it. I didn't get enough evidence. I was mostly going off of what I thought was likely to play out rather than looking for the triggers that confirmed it happening. And so even though we were in these levels, that didn't necessarily mean anything. It just meant we need to pay attention for triggers. Well, there was no trigger, price pushed through. So here we are. There's always something to learn, but what I just don't agree with which is very rare. Most of you don't have this opinion of me because you're here listening to me, but the occasional characterizations that I should be embarrassed that I was wrong, or that I've lost money somehow because I've been wrong, or that this is somehow kind of like a smudge on me or something. It's not at all. It doesn't affect me at all. It's just kind of something you have to learn from. And just because something is at its retracements in a really questionable period of time broadly doesn't mean that it has to react at that moment. Right? It just means that it's possible, that that's a place where you need to pay more attention than when you were down here. That's what it means to me. Eric Martinson gifted another membership. Thanks, bro. Thank you so much. Ryan Rendon also gifting a membership. Welcome. Welcome, Lucifer. Welcome, Jawad. Take a sip of my bone broth here. I've got a nice warm mug of bone broth. Well, it's not very warm anymore because I've been talking for an hour and 15 minutes. But I replaced my morning coffee with bone broth last year. Man, I love it. It's great. I look forward to it every day. I do like caffeine. I like coffee, but just makes me jittery, and it makes my palms kind of sweaty, and I just don't like the way it makes me feel. So bone broth, much better. Still get that sip of a hot beverage in the morning to kind of scratch that itch, Anyway. So it's been about an hour and 15 minutes. I want to wrap this stream up here in a timely way today. I don't want to go so long. So if there are things on your mind that you wanted to ask me about, things you want to talk about related to what we've been discussing today, make sure you get that into the chat now before we wrap up. Because we'll probably shut down here in the next maybe 10 minutes or so. Get myself a cup warmer. You know what, Dee? That's a great idea. I should totally do that. I think my wife has one of those at her desk across the hall. And I have not employed one of those because usually I don't sit down with a hot beverage. Usually I just sit here with my water, but I brought my bone broth today. Louis says, my body's weird. Coffee makes me feel weird, but if I drink a Monster, I'm good. I can't do those Monsters. I drink them every once in a while, but they just don't work for me. It's not my preferred flavor. Let's check around on the market. Let's see what's going on while we've been talking here. See if we missed any big movers. BTC still curling. Starting to see it bow over a little bit. If we look at this, like if I was lining this up for a trade, I would do this on the 12-hour. We've got this leg higher. Now trying to see if we get some structure in here that looks like it wants to turn. And if so, then I'll go down to a lower time frame, maybe try to look for an entry up here. But we still haven't broken down. Like structure hasn't really broken up here. You could go down to a low time frame and find that it has. But on the medium time frames, we're still just kind of consolidating up here near the highs. Kind of see what happens. I'm not really eager to take a trade right now. I actually have a few longs going that I got on some alts, actually. I set a few bids on some alts that caught this flush. Was this one? Whichever one yesterday. I guess it was this one. Wait, no. Here? Was this the flush yesterday? Yeah, Wednesday. That's it right there. I had some bids on some alts to go long because I'm a degenerate. But I'm not trying to trade BTC here. I'm just admiring the move and enjoying the appreciation of my spot bags. But BTC still hanging out. What's ETH doing? Looks the same. Total 3. Total 3 getting above key SR. So if Bitcoin and the total market cap is now above the March-May 2022 area here, the 2022 highs, total market cap is. Total 2 is about 230 billion away. So is total 3. About 230 billion away from the same level that Bitcoin just broke through. Will they get there? I would guess they would. I would assume so. Which is why I think alt season is not that far away. We've kind of been having one. History would say we should have one. If Bitcoin breaks the all-time high and then cools off a little bit, that could be the moment right there. I think, you're seeing the build. It's starting to build. It's starting to build, but the candles aren't that big yet. Bitcoin's almost there. I think once it gets above that, if it does a little back test, maybe chills out a little bit, maybe comes back underneath, that could be that moment where we get some real shitcoin craziness. We'll have to see. See, Dow Jones. Yeah, kind of a ho-hum day for equities. Not really going anywhere. Very, very mild, very flat. Russell's trying to poke, though. Russell poked above its highs right here. Yeah, today. Ooh, that's today. Look at that. Today, the Russell poked above an almost 2-year high. just this morning, right there. This is an interesting one because I said the Russell hasn't been participating, right? That's true. Small caps usually go in a recovery. That's true. They're still hanging out at their 0.5 fib. Maybe we get a little push up into this structure. What I think is possible. We got this structure up here, right? And then right below it just happens to also be the 618, which I know I just did a whole spiel about retracements. But on a big secular basis, the retracements are less specific as maybe on a trading basis for like a trade idea. And I think maybe we get a move up into this area for the Russell, which would be a sweep of this high. It would be a push into the 618, which we just saw in Bitcoin was a strong reversal. And it would be above all the highs of the last couple of years up into this consolidated structure right here. So that could be a nice move for the Russell. If it got back inside, that is a short. Into either here, not here, sorry, that's not there. Up into here, and maybe got back down into this range. That's a short. I think I'm going to go try a cup of broth today. Good idea, Luis. I'll show you the one I use. Kettle and fire bone broth. I use these guys, not affiliated with them in any way, shape, or form. But I buy the chicken and the beef, these two right here, unflavored. They've got some flavors, like a mushroom chicken one, and I don't know what those are. I don't care. I buy these two right here. I've got a bunch of these in my pantry, and each day I drink a half of one, which is a cup. It's got about 10 grams of protein. It's about a cup of liquid. Tastes real good. Could drink two. It just has a lot of sodium. You know, you get like 70% of your daily dose of sodium, which isn't necessarily bad. But yeah, I'm currently drinking a beef broth. All right. If you have not hit the like button, make sure to smash it. If you want to be part of the members stream, we will do one next week. So we'll do our live stream and then we'll do the member stream right afterward. So make sure you're there for that. And yeah, we'll probably wrap this up here today, guys. Wanted to talk through some of the stuff we're looking at. Didn't have like a big thing I needed to say or show you. I just kind of wanted to do an update, a little more of a stream of consciousness type of thing and not have specific points I needed to cover. So right now I'm just observing BTC. It's okay occasionally to just say, dude, I don't know what's going on. I don't know where we're going to go. I don't know how high or low we're going to go. I don't know what the end of the cycle is for Bitcoin, if it's close or if it's far away. Just because I was wrong about price stopping here doesn't mean that everything else I've said is invalidated. It just means I was wrong about the price. So we'll get other things wrong. I'm wrong all the time. But we'll just continue to try to make rational, reasonable guesses based on history and our analysis of the data. The economy is a slow-moving beast. As we have seen in this cycle, it has been proven countlessly. The market doesn't have to give a shit about the economy. It doesn't have to. It can ignore it up until the point when it can't anymore. It will actively try to ignore it up until the point when it can't anymore. So it is important to pay attention to both, but to understand that the stock market will do whatever it wants until it doesn't get a choice. And it's just dragged along with whatever thing it chose to ignore. The FOMO is real. You think there's FOMO out there, JB? There could be. I definitely see more sentiment picking up around Bitcoin. People like, oh, do you have some BTC? I saw it on the news. But are we going to get to the place where we have new stadiums being named after exchanges and we've got Dua Lipa tweeting about bonk at the top? Like, is that going to happen? I don't know, dude. I don't know if we're going to get that again. We'll see. Yep, this year's throwing everyone for a loop. That's true, me included. I never pretend to have it all figured out. I tell you guys, I don't fucking know. I'm just a dude on the internet. And there are people who get paid a lot of money to know what's going on, and they have been just as wrong as me. So don't think that your favorite influencer has it any better than someone else. There are some people that I know personally who have called the last year and a half better than 99% of others, and I applaud them. But it's been a very difficult thing to do. Bonk Arena has a certain ring to it. I like that. Last check on crypto before we go. Yeah, Bonk's still ripping. Ondo. I bought some Ondo the other day. Don't go do this right now because it's at the highs. That would be stupid. I bought some of this not that long ago because I heard them associated with BlackRock, and that was my entire thesis. I have no idea what this shit is. I don't know what it does. I don't know the market cap, who works on it, what its purpose is. It's absolute nothing to me. I just heard them associated with BlackRock, and in this retarded ass market, that's good enough for me. So I bought some spot and it's now up. That's how dumb the market is. And sometimes that's how dumb you have to be. But don't go do that with this one. Make up your own ideas. Jim Cramer's right all the time, duh. All right. So we've looked at Bitcoin. We've looked at equities. We've talked through the high level, what we think is going on. We blasted through some charts. It's been a hell of a week, so we're just going to let things simmer. Let it chill. Next week might be more conclusive. This is a process. Did that with Pepe. Yeah, CB, I've a couple of my alts have been that way, where I've literally just gone, oh, this is stupid. Let me buy that. This seems memeable. Let me buy that. Sometimes that's all it is. Sometimes that's literally it. But that is not investment advice. So until next week's public stream and member stream, don't forget, take care of yourselves, friends. I will be spending less time on Twitter because no one wants to hear what I have to say on there right now. I'm just going to give you guys my opinions, and we will observe this market as we always do. I'll talk to you guys a week from now. I look forward to seeing all of you there. So take care of yourselves, take care of your friends and family, and we will chat in just a few more days, good friends. Bye. Cheers.